Good morning, ladies and gentlemen. I'm so glad to see you at very early Monday morning, early hour Monday morning. You know, we have been running Distinguished Lecture Forum for the last 20 years. So many distinguished scholars and policymakers have attended has spoken at the forum. But somehow we missed the opportunity to host one of the leading economists, the most respected and influential economist in the world today. Professor Martin Feldstein is our special guest speaker this morning. Somehow we got this opportunity this morning. I'm so pleased to host this breakfast meeting. Professor Martin Feldstein has been teaching at Harvard University for many years. He is George F. Baker Professor of Economics at Harvard University. He has been holding that post since late 1960s. He has taught so many students, of course, including so many future chief presidential advisors in the United States. Lawrence Summers, Glenn Hubbard, Lawrence Lindsay, Harvey Rosen, all chief economic advisors to very different presidents in the United States. And so he still teaches principles of economics at Harvard. During the private conversation some time ago, I believe you told me that it is very important to teach senior person, to teach young undergraduates, particularly the introduction to economics. I think that is very, very important. So, professor like Martin Feldstein, teach basic principles economics. I'm sure many students will end up majoring in economics. But in any case, while he's teaching at the Harvard University, he has been leading National Bureau of Economic Research, which is, as you know, the most influential and trusted research arm in the United States. Actually, that institute has been in existence more than 100 years. Professor Feldstein also served U.S. government in various consultative capacities, including chief economic advisor's job for the Ronald Reagan administration, and also he served current Obama administration and former Bush administration in different consultative capacity. He wrote so many articles and books in economics, and he contributed so much to the field of economics. So in fact, he still is young, but he was younger. He was awarded with the most prestigious award given to a young economist below 40. The award is called John Bates Clark Medal. He was awarded with this medal in 1977. I can go on like this to tell you all about his brilliant academic career and public service. But for the sake of time saving, I will stop here. With no further ado, I would like to introduce Professor Felsen. Please join me in welcome.
Well, thank you very much. Il-Sakung and I are old friends. I first met him when he was finance minister, and we have seen each other frequently over the years since then. That's why he says such nice things about me. But I'm very grateful to all of you for coming. I look forward to the chance to talk to you about the U.S. economy and what is happening also to a certain extent in Europe and in Japan. And I'm sure I will learn from your questions after that. It's really an important time now to look at what is happening in the United States. The economy in the U.S. is changing, and there is a shifting policy environment as well. So let me talk about both of those, starting with the economic outlook. For the past few years, as Il-Sakung knows, because we have spoken about it just about every year, I have been quite skeptical about the short-term outlook for the United States. Although I believe with optimism about the long-term prospects for the U.S. economy, I didn't share the view of the Federal Reserve, of the administration, and others who said in the last few years that we would see economic growth of 3.5%, 4% real GDP. I kept saying I think we will be lucky if the U.S. economy grows at up to 2%. And in fact, that's all we were able to do in 2010 and 2011 and 2012 was to reach the level of 2% growth. It was much weaker than previous economic upturns. Real GDP per capita didn't get back to the level before our 2007 recession until 5 years later in 2012. And the unemployment rate has come down primarily because fewer people are looking for work. But now I am more optimistic about the prospects for 2014. I think GDP growth this year is likely to be closer to 3% than to 2%, could even exceed 3%. So I want to talk about why that's true, what the risks are, and then I want to focus on the Federal Reserve's monetary policy, because the Federal Reserve is really the only area of policy action, of policy change that we're going to see in 2014 and 2015. So I'll start with the outlook for 2014, the reasons that I'm optimistic that we will do better than we did the year before. The primary reason is that household wealth has increased very substantially as a result of the increased value of the stock market, the rise in home prices. Together, those added some $10 trillion to household wealth between the end of 2012 and the end of 2013. Even for an economy the size of the U.S., $10 trillion is a lot of money. It's more than half of our annual GDP, and that increase in household wealth will lead to increases in consumer spending. Past experience shows us that every $100 increase in household wealth adds about $4 to the level of consumer spending. So a $10 trillion increase in overall household wealth should add about $400 billion a year to the level of consumer spending, more than 2% of U.S. GDP. And it's not a one-time increase. It is a permanent increase associated with this higher level of wealth. And we can see that it is already beginning to happen. We see it in the decline in the household saving rate, which, having been at close to 6% of after-tax income in 2011 and 2012, fell to a most recent number of just a little over 4%. So a decline in the saving rate of about 2%, adding more than 1% to the level of GDP. And I think that higher level of consumer spending will continue in 2014 and beyond. The second reason why I think we will have stronger GDP in 2014 is that we no longer have the fiscal headwinds of increasing taxes and cuts in government spending. Last year, 2013, there was an increase in the personal income tax. There was also a substantial increase in the payroll tax, and federal government spending fell, subtracting about 1% from the growth rate of GDP in the most recent quarter. Well, none of that is going to happen again in 2014 or even in 2015. The U.S. Congress recently passed a budget, not only for this year, but for next year as well. The budget says no increase in taxes during that period and no additional cuts in federal spending. We already see in the estimates for the first part of 2014 that federal government spending will be increasing, adding to GDP rather than declining. And in addition to that, state and local governments, which in the U.S. represent about 1/3 of all government spending, state and local governments are also now able to expand. So for these two reasons, higher consumer expenditures driven by higher household wealth and the absence of increased taxes and reductions in government spending, for those two reasons I think we will see higher GDP growth. Now, the recent budget agreement is therefore good news for the short-run recovery of the U.S. economy. But unfortunately, it does nothing to solve the long-run fiscal problem that we have, the problem of rising budget deficits and debt. That subject has been ignored and will continue to be ignored until after the congressional elections at the end of this year, and I'm afraid probably until after the presidential elections in 2016. And that's really unfortunate because the long-term fiscal situation is serious, and any serious solution to it must be introduced gradually. Let me just take a moment to explain. Before the recession began in 2007, the U.S. federal government debt was less than 40% of GDP. 5 years later, it had doubled to 74% of GDP. Some of that was for cyclical reasons, less tax revenue, more transfer payments. Some of it was because of the Obama administration's spending program. But annual deficits rose sharply in the recession, but now they have come back as a result of the economic recovery, of cuts in defense spending, and of increases in tax rates. But now the deficit is about 3% of GDP, the annual deficit about 3% of GDP, and that means that the overall size of the debt will grow at about the same rate as nominal GDP, so the debt to GDP ratio will remain at about 75%, won't improve at all. The Congressional Budget Office, the nonpartisan staff of the Congress, projects that by the end of 10 years, the deficit, the annual deficit, will be up to 4% of GDP if no policies are taken to change it. And that reflects higher interest on the national debt and the effects of an aging population in our transfer programs to middle-class seniors. With that increase in the deficit to 4%, we will be on a path of rising debt to GDP ratio heading toward 100% of GDP. So we really need a major budget agreement to reduce the deficit and therefore to put that path toward lower debt to GDP ratios. Requiring annual deficits and reducing those annual deficits will require slowing increases in the middle class, programs for the aged, and limiting the special tax breaks, the so-called tax expenditures. I think there's a broad understanding of this even in Washington, but really no acting compromise between Republicans and Democrats. President Obama the other day submitted a budget moving in the opposite direction with increases in spending on a variety of programs. Everyone knows that that budget is not to be enacted because we already have a budget for this year and next year. It's really just a campaign statement to try to help Democratic candidates in the current congressional election. So I'm afraid we can forget about budget policy and serious tax reforms for the current year and probably until after the 2016 election. So let me return to the risks to the growth outlook for this year and next year. The recent data has been very mixed, but very cold weather has contributed to reductions in spending and in job creation, so we have to look beyond the last couple of months. And there I see three interrelated risks. The first of these is housing. House prices began to fall in the middle of 2006, bursting a bubble of house prices and starting the economic downturn that finally generally began at the end of 2007. Fortunately, by 2012, house prices had started back up again, reflecting a combination of the low interest rates caused by Fed policy, the substantial decline in the price of homes and therefore improvements in affordability, and the demographic changes as more people need to be housed. The increase in house prices led to higher household wealth and therefore more consumer spending, as I said a few minutes ago. But more importantly, the increase in house prices also led to increased investment in housing. Real spending on house construction increased at a 15% annual rate in 2013, but it was coming from such a low base that it added only 0.3% to GDP. Unfortunately, more recently, housing has turned down. Primary reason for that was the increase in mortgage interest rates that followed when the Federal Reserve announced that it would start to reduce its purchase of long-term bonds. So the 30-year mortgage rate, the standard mortgage product in the U.S. market, moved from about 3.5% to about 4.5%, therefore making it more expensive for people to buy and eliminating many potential buyers from qualifying. So last year, in the final quarter of the year, investment in residential construction fell at a 13% annual rate, subtracting about 0.3% from overall GDP growth. And more recently, the sales of existing homes has declined. That's led to declines in housing starts and in housing permits. So I should emphasize that although housing construction will have a negative impact on GDP this year, the magnitude is relatively small, subtracting only a few tenths of a percent from the GDP growth rate. The second risk to my optimistic outlook for this year is in net exports. Trade is, of course, a relatively small part of the U.S. economy. Imports and exports are each about 15% of our GDP. Nevertheless, the increase in net exports added nearly a full percentage point to the GDP growth rate in the final quarter of last year. But going forward, I think net exports may be a drag on growth this year and perhaps next year because of slower growth of our trading partners in Europe, in China, and elsewhere, and because of the rising value of the U.S. dollar. Over the last decade, before 2013, the U.S. dollar on a real trade-weighted basis fell by more than 25%. So that made U.S. products more competitive, and it made foreign imports less attractive to American buyers. But that has recently turned around. The dollar has started to appreciate, primarily because of a sharp decline in the value of sterling and a sharp decline in the value of the Japanese yen. So I think at best, U.S. net exports will be stable in this year and next year, although, again, looking a little further ahead, we may see a significant increase in U.S. net exports because of the revolution that is happening in the production of oil and gas in the United States. The third risk to growth this year and next year is the rise in consumer spending. I emphasized that the increase in personal consumer expenditures is primarily being driven by an increase in household wealth. But it is because consumption is driven by wealth rather than by an increase in household incomes that I am concerned. Incomes are simply not increasing and may not increase any more rapidly in 2014 than they did before. Here are some of the facts. If you look at wages, real average weekly earnings, they have increased over the past 12 months by less than 0.5%. If you look at the most recent data on real disposable personal income per capita, it actually fell in the fourth quarter of last year. And yet, despite that, consumer spending rose at more than a 2% annual rate. So consumption is being driven by the increased wealth of the people who have substantial amounts of equities. That makes consumer spending and the increase in GDP vulnerable to equity prices. U.S. equity prices rose more than 30% last year. And the key reason for that, I believe, was the very low long-term interest rates. That 30% increase was a big increase in price-earnings ratios. So it was the low long-term interest rates that drove portfolio investors to seek higher returns in equities, and that fed on itself. But that makes consumer spending potentially sensitive to changes in the Fed's monetary policy. So let me turn now to talk more generally about what the Federal Reserve has been doing and about future Federal Reserve policy, because I think that Fed policy has created a separate series of risks, and the changes that are now beginning at the Fed will create new risks. Moreover, when I look a little further ahead, I worry that the Fed has created a risk of inflation and of how it will deal with inflationary pressures. To put the Fed's monetary policy in perspective, I think it's useful to recall that the Obama administration tried to stimulate the economy back in 2009 and 2010 with a series of fiscal deficit policies. These policies were poorly designed. They gave some temporary boost to GDP, but they did very little beyond that. They added more to the national debt than they did to GDP. After that experience, there was relatively little willingness to even consider further fiscal policy. So by early 2009, the Fed saw itself as the only way of improving aggregate demand. But by then, the Fed had already reduced the short-term interest rate, the federal funds interest rate at which banks lend to each other, had already reduced that close to zero. And yet those low interest rates didn't stimulate demand because house prices were still falling sharply and lower interest rates wouldn't induce people to buy homes when the prices were coming down. And also banks were not willing to lend because of a weak and uncertain balance sheet. So the Fed began what Ben Bernanke, chairman of the Fed, what Ben Bernanke called unconventional monetary policy, which had two components. The first was quantitative easing, or in the Fed's language, large-scale asset purchases, where the Fed bought very large quantities of treasury bonds and of government-guaranteed mortgage-backed securities. And the second part of this unconventional policy was forward guidance about future short-term interest rates. The purpose of this unconventional monetary policy was to reduce long-term interest rates in order to cause portfolio investors to shift to equities, to real estate, and to other assets. The Fed predicted that that would lead to an increase in the value of those assets, that would lead to higher household wealth, and that would produce more consumer spending. Last summer, Chairman Bernanke announced that the program of large-scale asset purchases would start to shrink, to taper, to use the Fed's term, and that it would stop buying by sometime this year, sometime in 2014. And that is now happening. The Fed had been buying $85 billion a month of treasuries plus mortgage-backed securities. It's now cutting that at a rate of $10 billion every time the Fed meets, and that means we will be down to a zero rate of purchase by the end of 2014. I think that's a good thing. I think it's a good thing because the large-scale asset purchases and the resulting low long-term interest rates, remember the 10-year Treasury interest rate in the U.S. got down to 1.6% in the summer of last year. You would have expected it to be more like 4%. 1.6% meant in real terms it was very, very close to zero. That resulting low long-term interest rate, I think, has been the source of risks to the U.S. economy and indeed to the global economy. For the U.S., there were three primary risks caused by these low long-term interest rates. First was an increase in asset prices, as investors facing these low long-term rates bought equities, farmlands, low-quality bonds, and so on. Also, they were buying them often on margin, increasing risk and leverage. The second risk caused by these low long-term interest rates was the increased risk-taking by lenders rather than investors, by banks and others. Lending to borrowers with low credit ratings, a return to the growth of the subprime market, and lending with fewer conditions on the loans, so-called covenant-light loans. And third was increase in risky investing by portfolio investors, reflected in asset prices, in corporate acquisitions, and also in the use of derivatives to boost yields in an obscure way. I think the adverse effects of these three risks may not actually occur. I hope they will not occur, because the economy has continued to expand. But if the economy were weaker, or if the economy becomes weaker, those three risks may cause serious problems for the economy. Ben Bernanke and his successor, Janet Yellen, and others repeatedly said that the decision on the volume of these large-scale asset purchases requires balancing the risks being created by doing so and the benefits to the economy. Their judgment, until recently, was that the benefits outweighed the risks. My judgment was that in recent years the opposite was true. We were creating more risks of the sort I just described than benefits. So I think it's a good thing that the Fed is gradually stopping these large-scale asset purchases and allowing the long-term interest rates to increase toward normal levels. The 10-year Treasury bond rate went from 1.6% last summer up by more than a full percentage point to where it is today. Now, the second aspect of unconventional monetary policy is this forward guidance with respect to future levels of the federal funds rate. The Fed's statements with respect to that, the nature of the guidance, has changed from an original statements of a kind of vague, we're going to keep the federal funds rate low for a considerable period of time, to a more specific date. We'll keep it low at least until such and such a date. And then more recently, to a formula in which they have said we will keep the federal funds rate close to zero until the unemployment rate drops below 6.5%, unless inflation rises above 2.5%. Well, as the unemployment rate has now gotten close to 6.5%, it was 6.7% in the most recent measurement, the Fed has stressed that 6.5% is just a threshold, not a trigger. In other words, that when it gets to 6.5%, they're not obliged to keep the interest rate low, but they are certainly not obliged to raise that interest rate. Indeed, the Fed has emphasized more recently that they're going to wait until, in their terms, the labor market has significantly improved. And they have noted that the unemployment rate that they have spotlighted in the past is really not a good measure at a time when labor force participation is falling, when there are many long-term unemployed, and when many are involuntarily working just on a part-time basis. So where does that leave forward guidance? I think the result is a very ambiguous message. Although the Fed stresses that it wants to communicate to the public and to the financial markets what it's going to do, its statements now that its actions are going to be dependent on the data as it comes in, and that they will look at a variety of measures, not just the unemployment rate, but labor force participation, the number of long-term unemployed, the number of people involuntarily on part-time, means that there is no clear picture of what the Fed will do. I think many market participants simply don't believe the Fed's statement that tapering is not related to adjusting the federal funds interest rate. I think that those at the Fed who want to keep long-term rates low will now shift their strategy from bond buying to forward guidance, hoping to keep long-term rates low by promising to keep short-term rates low for an extended period of time, even after the unemployment rate drops to 5.5%. Now, if I thought that that strategy would actually keep long-term rates low after the end of the bond buying by the Fed, I would be worried about this forward guidance strategy. But frankly, I think it will actually fail. I think it will not keep long-term rates low. 7-year rates, mortgage rates, 10-year treasuries, I think will not be kept low. Even a strong supporter of forward guidance, like the president of the San Francisco Federal Reserve, recently wrote that forward guidance is good for keeping rates down up to 2 years into the future. But he made no attempt to claim that it would keep long-term rates low. So let me turn from what the Fed has been doing, large-scale asset purchases and forward rate guidance, to what, in my judgment, it is not doing but should be doing. In my judgment, the Fed is not dealing with the risk of future inflation. Current inflation in the United States is, of course, very low. The most recent 12 months saw the consumer price index increase at just 1.2%. Unit labor costs rose at only 1.1%. So the question and my concern is about the future rate of inflation and what the Fed is saying and not saying about its anti-inflationary policy. It's important to recognize how rapidly inflation can rise. If you recall, the Consumer Price Index inflation in the first half of the 1960s was only 1.4%, very similar to where it is today. By the end of that decade, it had moved up to 5.5%, and by the middle of the next decade, it was 11%. So inflation can rise very, very rapidly. Now, the Fed has a so-called dual mandate, price stability and low unemployment. But recently, the Fed seems to have forgotten that the dual mandate includes price stability. There's virtually no mention of inflation in the Fed's pronouncements, except such formulaic phrases as, "We do all this in the context of price stability." But it's clear that the Fed is really focused on slack in the labor market. I think it's important for the Fed to reassure the public that it will not tolerate rising inflation and will take steps to prevent a recurrence of rising inflation, even if that requires increases in the unemployment rate. Experience has taught us that public confidence that the central bank is going to prevent an increase in inflation makes it easier, less costly in terms of increased unemployment, to prevent or reverse inflation when the time comes. Recall in the 1960s and 1970s, the Fed didn't act strongly enough and therefore allowed inflation to get higher and higher. I think it's important for the Fed to confirm that as inflation increases, it will now raise real short-term interest rates and stop or reverse that increase in inflation. I think it's also important for the Fed to make clear that it doesn't accept the view that allowing a higher rate of inflation now is an acceptable way to stimulate demand by reducing real interest rates. So much for what I think the Fed should be saying, but it takes more than just rhetoric. There needs to be a strategy of how the Fed will act when inflationary pressures begin. So what is the source of this potential future inflation? It is not that quantitative easing has greatly expanded the money supply, a statement that I hear very often. Although the commercial banks received trillions of dollars of reserves, the commercial banks did not convert that into increases in the money supply. Instead, they deposited those funds at the Federal Reserve. The growth of the broad monetary aggregate of M2 over the last 12 months was just about 6%. The inflation risk is this, that commercial banks will use the enormous excess reserves at the Federal Reserve to start lending when corporate borrowers with good credit are prepared to borrow. Now, to some extent, that increase in lending will be welcomed by the Fed and others until the economy is fully back at full employment. But how will the Fed respond when lending is excessive and leads to inflationary increases in demand? The Open Market Committee and Chairman Yellen, I think, need to tell us how they will deal with that. The traditional strategy of intervention to increase the federal funds interest rate won't work because commercial banks don't need to borrow in the federal funds market. They have hundreds of billions of dollars of federal funds. As an alternative, the Fed could increase interest on excess reserves. It pays interest on excess reserves, and it could keep increasing that interest in order to cause the commercial banks to leave their funds at the Federal Reserve. But paying higher interest on excess reserves would create two serious problems for the Fed. First, it would be politically awkward for the Fed to pay large amounts of money to commercial banks as a way of discouraging those banks from lending to businesses and households. And second, it would also be politically awkward for the Fed to pay interest on the more than $4 trillion of excess reserves that it earns more on payments of interest than it earns on the portfolio of bonds and mortgage-backed securities that it holds. So high interest on excess reserves, I think, is not a viable strategy for limiting commercial bank lending, especially if those interest rates have to be substantial to prevent increased inflation. More recently, the Fed has been talking about a program of using repos or reverse repos to manage short-term market interest rates. What does that mean? Dealing in repos are essentially action by the Fed to sell securities from the Fed's portfolio to the market with the promise to buy those back at a price that implies a desired interest rate. That would allow, acting in terms of this market for repos, would allow the Fed to deal with a wide range of financial institutions, more than just the commercial banks, and it would do so in a way that obscures the interest rate that it is paying. But while using repos may obscure the implied interest rate, it wouldn't stop the Fed from losing money by paying more than it receives on its portfolio of bonds and mortgage-backed securities. And to be effective, the Fed will have to be willing to push up short-term market interest rates high enough to deter excessive commercial borrowing. So it's not at all clear to me how the process will, in the end, limit the desire of banks to use their excess reserves unless the Federal Reserve is prepared to significantly increase interest rates. The alternative to any of these interest rate strategies is to use quantitative restrictions to limit the bank's ability to increase their lending. One form of that would be to increase reserve requirements, making it impossible for the commercial banks to use all of their existing excess reserves. A different form of quantitative restriction would be to increase the capital requirements imposed on the banks, particularly an increase in the leverage ratio. I'm not advocating any of this, but I think it's important for the Federal Reserve to explain now how they will prevent the banks from using their current short-term assets to finance inflationary lending in the future. Well, let me shift from these comments about the U.S. to say a few brief things about the situation in Europe and then in Japan. Let me look first at Britain. Although Britain as such is not important in the global economy, don't tell my British friends I said that. Its experience, the British experience, presents a useful lesson. The key lesson is that combining fiscal authority with currency devaluation can achieve both reduced budget deficits and increased economic growth. So here are the facts. In 2010, Britain had a cyclically adjusted budget deficit. In other words, a budget deficit if the economy were at full employment, according to the IMF. It had in 2010 a cyclically adjusted budget deficit of 8.4% of GDP. This year that number is 3.9%, so it has cut it more than in half. But despite that decline in the deficit, Britain's real GDP is now increasing at a rate of 2.8% this year, and that's faster than any of the Eurozone countries. Britain's unemployment rate is only about half of that in the Eurozone, and its inflation is just about 2%. Now, Britain still has other problems, but my point is that it was able to combine deficit reduction with growth of demand by reducing its exchange rate. Sterling fell, the pound fell by about 25% against the dollar and more against the euro. Let me turn to the Eurozone itself. The good news is that the euro has survived, and there is now very little risk that any of the Eurozone countries will want to exit the euro. Mario Draghi's promise that he would do whatever it takes to preserve the euro has worked, and it has succeeded in causing the interest rates on government debts to fall sharply, both absolutely and relative to the yield on German bonds, so that Italian and Spanish government 10-year bond interest rates are now down at about 3.5%. So that's the good news. But economic activity in the Eurozone is still very weak, and there's little prospect of improvement anytime soon. For the Eurozone as a whole, GDP growth is just about 1%, and the unemployment rate is 12%. Indeed, of all the major countries in the Eurozone, only Germany has a real GDP growth of more than 1% and an unemployment rate of less than 10%. The other major countries have GDP growth rates of less than 1%. The unemployment rate is more than 10% in France and in Italy, and it's more than 20% in Spain and in Greece. There is no significant growth at either the Eurozone level or in the individual countries, and no significant strategy for making it happen. The so-called Fiscal Compact requires all Eurozone countries to have budget deficits that are below 3% of their GDP and debt ratios that are heading to 60% of their GDP, with a threat of fines if they don't do it. In fact, it's not happening. France, Italy, and Spain all have deficits greater than 3% and debt ratios over 60% and rising. And of course, no country is being fined. The banking plan was supposed to have a Eurozone-wide deposit insurance, a Eurozone-wide system of dealing with failing banks. Those have been dropped completely. All that remains is some centralized banking supervision. And the individual commercial banks in the Eurozone are still doing very little lending and virtually no cross-border lending, ending the idea of a common credit market in the Eurozone. The inflation rate in the Eurozone has dropped below 1%, driven down in part by a rising euro, which has increased by 6% relative to the dollar in just the past 12 months. So Mario Draghi speaks about trying to increase inflation and prevent deflation, but he has very limited tools for doing it. In my judgment, the obvious policy for the Eurozone would be to devalue the euro from now $140 per euro to perhaps $110, a 20% devaluation. That would not only raise the inflation rate back to the 2% target, but would stimulate exports, reduce imports, and therefore raise the rate of GDP growth. Although the European Central Bank has resisted this, the time may eventually come when it sees the need for action. Let me finally say a few words, very few words, about the situation in Japan. So far, the Abe strategy appears as a success. Although the structural reforms, the third arrow in the Abe strategy, has not occurred, GDP and inflation are both up. The inflation rate is now over 2%, and GDP is increasing at a 1.5% rate. But it's not clear how sustained this will be. The inflation increase is driven by the increased import prices resulting from the 10% fall in the value of the yen in the past 12 months. And the increase in GDP demand may reflect buying ahead of the scheduled VAT increase, which is about to happen. When it does happen, real incomes will fall, and the incentive to keep buying will no longer be there. But to me, the most worrying aspect is that Japan still has a budget deficit, a fiscal deficit of 8% of its GDP, despite paying virtually no interest on its national debt, an interest rate on JGBs of less than 1%. That means that Japan's debt-to-GDP ratio will continue to rise from its current level of more than 200%, about 240%. Well, with a current account surplus of less than 1% of its GDP, Japan will soon be forced to finance its government debt on the international capital markets. When that happens, as is even is widely anticipated to begin happening, the interest rates on JGBs can no longer continue to be at less than 1%. But a normal interest rate on JGBs, say 3%, combined with an inflation rate of 2%, would add about 5% to the fiscal deficit. It's hard to see how Japan resolves this without substantially higher value-added tax that will then cause a downturn in the Japanese economy. So I think they are on a non-sustainable path. Well, I've talked about a lot for a long time. I now look forward very much to your questions. Thank you very much.
Well, thank you very much for very, very insightful and penetrating analysis of the U.S. economy and the Eurozone, and also touched on Abenomics and Japanese economy. Well, with this, why don't I invite some questions and comments from the floor, and then have some interactions. Any? Tatan, you have, yes.
Professor Feldstein, I'm really delighted to see you again after seeing, 3 times at China Development Forum, Beijing. Indeed, very comprehensive, insightful analysis of key macroeconomic variables. But my question is rather related to your brief comment on U.S., net export side. In order to sustain the U.S. economic recovery, and I know that this President Obama and the Vice President Joe Biden have been pushing through very hard the open trade regime, especially pushing the transatlantic trade and investment and TPP. Now, my question, especially TPP, Korea is deeply related. We expressed our interest in joining the TPP process. At this point, I think U.S. Congress is very reluctant to approve the President Obama Trade Promotion Authority, and this entire negotiation process is undertaken in a closed door, and we do not know where it is standing. So my question is that how do you view the President Obama will push it, the current TPP, and what time, and how the negotiation between Japan and Korea, Japan and the United States will resolve the conflict issues, especially in the opening of agricultural sector. Thank you very much.
Well, okay, why don't we invite a couple more of the questions? Yes. Professor Hong, yes.
Thank you, Professor Feldstein. I have spent a couple of times during 60s and the 70s at Harvard. Even that period, I read your articles, and your comment has been quite critical and helpful for me to understand. I would like to raise your opinion, the possibility of so-called carbon tax, about that. As you have mentioned, in between, U.S. economy has been enjoyed so much attributable to so-called shale revolution and these things. But your Congress is against about these carbon tax systems to exercise. But recent movement, as long as I know, of U.S. business, they think is inevitable to exercise a carbon tax system. So there is such a strong recommendation for Obama to take his presidential authority to take into effect of this carbon system. How do you foresee, because more and more attributable contribution of shale revolution to U.S. economy is enormous, therefore in effect that, as mentioning by New York Times, inevitable to exercise of that. I would like to ask your personal view of these systems.
Okay, Dr. George, please.
Thank you. Thank you very much for your very insightful analysis of the global economy. You mentioned that the reason why British economy could achieve such a successful performance was due to their exchange rate devaluation, despite of the fiscal contraction. You also mentioned that Mario Draghi now needs further devaluation of euro. I guess perhaps Britain has been lucky to have been able to have this devaluation. But how can Eurozone drive the exchange rate devaluation? Should they just be hopeful to be lucky, or do they have any policy measure within their domains to drive it?
Okay.
So you'd like me to answer those three, all very important questions. With respect to TPP and Trade Promotion Authority, or Fast Track, the key thing is Fast Track would give the president, give the administration the ability to negotiate a deal and then come back to the Congress for an up or down vote. In effect, taking away from the Congress the ability to modify what is agreed in the international negotiations. And frankly, you need that to make those negotiations work. Without it, nobody wants to negotiate, knowing that whatever is agreed is going to be then reopened in the Congress. But it's very hard for the president to get that kind of authority. It's not clear how much the Japanese in particular are going to be prepared to give up in order to get TPP. So, and the president really has very little persuasive authority now with the Congress, in part because of the ill will that has been generated by recent negotiations or non-negotiations between the president and the Congress, in part because of the president's own low popularity and the fact that we're coming up to an election. And members of Congress are very sensitive to the fact that they are coming up for an election in November, and that if they take positions that leave them open to attack in that election, they're going to pay a very high price. So I don't think that it's I would say it is a less than 50% chance that we will actually see TPP. What about the carbon tax? I personally would go along with some form of carbon tax. Particularly the simplest thing would be a gasoline tax. If gasoline prices come down, as they're likely to as a result of the development of improved drilling in the United States, so that the tax could absorb some of the lower pre-tax price that comes about from that, I think that would be a good thing. But if you recall, when the Obama administration first came, there was a very elaborate carbon tax plan put forward with all kinds of give-backs to individual states and localities. The states are very sensitive to their own local interest. If you're a coal-producing state, you don't want a tax on coal and so on. So I think a comprehensive carbon tax is not likely to happen. A more targeted carbon tax on gasoline could well happen. What about the falling euro? What can Mr. Draghi do about it? Well, I noticed that he has recently begun to say that the rising euro is a problem, that getting up to 140 to the dollar is a problem for the Eurozone, is contributing to their deflation. So that's the first thing that he can do, to signal to the markets that he is unhappy with what is happening, because that suggests that the next thing may be some action. And the primary form of action that could actually do it would be direct intervention in the market for euros, actually selling euros to give them a push down. A less dramatic thing would be moving from the low interest rate that's now available on deposits at the ECB, moving to a zero interest rate. Again, more as a signal than as a pure incentive. But I think if that doesn't work, then intervention, to me, would make sense, because I think otherwise they're going to see the risk of moving to deflation and certainly the continued low growth of the Eurozone economy.
Okay. Dr. Shin, please, and then Ambassador.
I have a very simple question.
Uh-oh.
Because you didn't cover Chinese economy, because for the first time in recent years, China recorded trade deficit of $23 billion. And there is quite a concern about decrease in growth rate in China. So how it will affect, what is your view on Chinese economy?
So I have a generally positive view of the Chinese economy. I think they are going through a transition which inevitably cannot be counted on to be perfectly smooth. But among their goals was a reduced reliance on net exports, more reliance on domestic demand, on consumer spending, on retail activities, and we're certainly seeing that happening. So it doesn't surprise me if they actually move to a negative trade, small negative trade number. I think that's consistent with their goal of getting. They had a 10% of GDP surplus just a few years ago. Last year it was under 2%, and now, as you say, it's moved to the other side of zero. What is concerning to me about that is not what it means for China, but what it means for their demand for dollar bonds. As a country with a large current account surplus, they were a big buyer of dollar bonds. With a current account deficit, they're not going to be a buyer, and if they want to go on investing in oil and in real estate and in businesses, they're going to have to be sellers. And I think that will contribute to upward pressure on U.S. long-term interest rates.
Ambassador.
Greetings, Dr. Felicien. I am the Ambassador of India. I wanted to solicit your views on the U.S. effort to onshore industry or homeshore industry, as it is said. Now, it is not so much on economic considerations but political. Two questions. A, whether it is a viable proposition, and two, whether it's a desirable proposition given the fact that it literally flies in the face of globalization. Thank you.
It's a politically attractive proposition. It's a good thing to talk about, to promise your constituents, but it's not happening. There will be some of it happening because of the lower energy costs. One of the debates now in the United States is to what extent we should allow the export of gas from the United States. Right now we have a tremendous cost advantage, and if we keep that all bottled up in the United States, that will lead to some onshoring or reverse. But I think that would be a very bad policy. I think it's not going to happen. I think the events with Russia and the Ukraine will speed up the granting of licenses to allow exports of gas from the U.S. So I don't see it as more than just a rhetorical thing that politicians can say we're going to do whatever we can to create jobs here at home. But I don't see it happening.
Okay, the last question. Yes.
예, 안녕하세요. 저 케미칼 에너지 투자자원의 차홍성 대표라고 합니다. 중국과 연결된 질문입니다. 그 중국이 과거 과거 중국은 이제 10% 고성장을 했는데 최근에는 여러 가지 개혁을 통해서 이제 7.5% 경제 성장률을 떨어뜨린 걸로 알고 있습니다. 중국이 성장보다는 개혁을 할 정도로 그렇게 문제가 심각하다고 보시는지, 중국의 문제가 뭔지 묻고 싶습니다. 감사합니다.
I think they, as I said in answer to an earlier question, I think they want to transform the economy to be less dependent on exports, and therefore that's going to have a price in terms of, during the transition, of a movement to a lower growth rate. I think it cannot be expected to keep growing at 10% a year. I first went to China in 1982, and they've more or less had 10% growth rates annually for 3 decades. That was a remarkable, a wonderful transformation. But 7% isn't bad. If they now come down to 7% and in the process transform the economy, have more going into consumption, more into services, they can create the jobs in that way rather than through very, very strong but concentrated industrial growth.
Oh boy, yeah, maybe.
Sure.
Actually, he has 2 interviews, but okay, okay, there, yeah.
Since I have the microphone,
Yeah.
Professor Feldstein, you
Yeah,
mentioned
yes.
that the Fed should start paying attention to the possibility of future inflationary pressure. Obviously, Fed doesn't feel that way at this point in time. Obviously, the Fed feels that U.S. economy is not ready to take off yet, so they're still concerned about not inflation, but more about growth and unemployment issue. So what would be, in your opinion, be the data point indicator that would give a wake-up call to not just the Fed, but actually in many other countries? We have forgotten about the inflation in the world.
Well, probably it would be increases in wages, increases in unit labor costs. That would do that. But what I'm calling for is the Fed to have a strategy and explain a strategy so that the public is confident that when that begins to happen, we will not get a repeat of what happened from the early 1960s over the decade after that, taking us up to double-digit inflation.
네, 한국말로 질문 드리겠습니다. 오바마 대통령의 최저임금 인상에 대해서 한국에서도 많은 이제 근로자들이 관심이 많습니다. 여기에 대한 배경과 전망에 대해서 좀 부탁드립니다.
Okay, why don't we invite Scott and the assembly? Yes, Scott.
Thank you. Dr. Feldstein, thank you very much. Can you comment a little bit on what you think the impact of global imbalances has had on the global economy? And it doesn't seem like we're seeing any kind of significant shift in this. We still have countries like Germany, with huge surpluses. They need to go somewhere, and other places, and that seems to be leading to other problems.
Okay, the last
Thank you very much for your comments this morning, Dr. Feldstein. What you said about what's happening in the U.S., increases in prices of the residentials, mortgages, the equities, whatnot. It seems like it's ingredients for crisis that I read a few years ago, except the main driver this time is the government rather than the private sector. And looking at the history, it seems that the crisis will always repeat itself. But before there was a government, U.S. government there to save the U.S. economy. But I just wonder, and my concern is who's going to be there next when something hits the fan.
So first about the minimum wage. the minimum wage in the United States affects very, very few workers. Very, very few. Many people who would be subject to the minimum wage, which is about $7 an hour, are young people, students, and the law doesn't apply to them. So very few people would be affected. But it is a politically attractive thing for President Obama. And it has succeeded in separating the Republicans who oppose it from President Obama. So I think it's probably a mistake of the Republicans to so forcefully oppose the minimum wage increase rather than agreeing to some kind of a compromise or gradual increase. If they could get an agreement so that the minimum wage was permanently linked to inflation, that would be very good for Republicans, because it would mean they wouldn't have to face this debate every time a Democratic president or a Democratic politician calls for higher minimum wage. So whether it'll pass or not, I don't know, but I think you have my view of what should happen. Global imbalances. You're right. Germany has all of the trade surplus, just about all of the trade surplus of the Eurozone. Germany and the Netherlands have the trade surplus. Everybody else has a trade deficit, and you put it all together, and it's just about a balance. I don't know whether that's really a serious problem. The problem is a lack of aggregate demand in all of these other countries. If you took the United States, maybe you would discover that New York and California have big surpluses, and Tennessee and Virginia don't. I've just made up those states. I don't know which would be which. So from an aggregate point of view, the global imbalances are not a significant problem for the U.S. And within Europe, I think the problem is more one of how does one stimulate, how does one increase economic activity in the countries other than Germany and the Netherlands, rather than trying to shift demand within the Eurozone. There's no good mechanism for doing that, and telling the Italy and Spain and so on they have to act more like Germans doesn't seem to be a winning strategy. So I didn't want to give the impression that the imbalances in the U.S. now, the rising prices of equities, are being driven by the government. They're being driven by the Fed in the same way that the house price bubble and equity price bubble was before the downturn in 2007. So it's not government spending, not government policies. It's strictly the Federal Reserve. And I hope that the combination of cutting back on the buying, the tapering, will mean that interest rates have already begun to normalize. I think they could go up another 100 basis points or more, get back to more realistic values, and so we could avoid the kind of problem, and therefore don't have to ask how to rescue it. Last time, as you pointed out, the rescue required bringing together both the Fed and the central government, because monetary policy itself didn't have the traction, the force needed to deal with the downturn.
Yeah. We can go on like this all day. It's a very rare opportunity to have Professor Dave Feldstein with us. As I said, somehow we missed the opportunity to invite him to speak at this breakfast meeting. Although he attended our institute's other conference together with Peterson in Washington, D.C., but he somehow we missed the opportunity, but I'm so glad to have this the opportunity this morning. Well, as expected, he enlightened us with his penetrating analysis of the U.S. economy and the global economy. In fact, he was brought here by the Citadel Asset Management, and so Oliver is there, and he's on his way to Tokyo and Shanghai and Beijing for this the company activities. Well, after this, we have two major newspapers interviews, so he has a busy schedule today, so we have to end here. But with this, maybe we should invite him more often. I hope Citadel bring him here more often so that we can take advantage of that opportunity. Well, thank you very much for your these generous generosity for sharing your views with us this morning. Well, please join me in thanking Professor.
Thank you.